Good morning, everyone. Welcome to Cama para el Comercio. Today we are going to talk about accounting and some topics that are related to finance. Okay, I hope everyone has a great morning. Hope everyone is fine. I hope you're taking care of yourselves. Remember, only go out when it is necessary. Well, like I said, the topic of today's lecture is going to be accounting and finance. We're going to talk about some terminology related to accounting, and also at the end, I'm going to show you some terminology related to billing and finance itself. Okay. So as always, my name is Carlos Martinez Flores. I am an English instructor and speaking coach. I am a former team leader at Pacific University, and currently I work at Mater Purísima School in Miraflores as an EFL teacher. Okay, remember that sometimes the topics of these lectures are going to be general English, like it was a couple of weeks ago, related to pronunciation and maybe some grammar and things related to the language. But most of all, it's going to be English for specific purposes. In this case, business. Okay, so we're going to practice our English, not learning grammar rules, but um, talking about specific business topics using the English language. So let's begin. When we talk about accounting and finance, we need to talk about four specific things that I consider to be relevant for this topic. Okay. The first one is the finance and the organizational structure, meaning how the company or the business is organized according to or referring to accounting. Then we have to manage the cash flow, the how money goes through and is used in business activities. The source of new funds whenever you need to get you are running low on cash and you need more funds. And finally, issues in the financial management. In this case, when I mean issues, I mean problems or things that could occur or things that could happen that might alter the normal flow or the normal way of things working. As always, these are the four topics that I'm going to go in depth in a little bit. And also, I want to make you notice what's in the picture where you see this balance and one says income and the other one says expenditure, and then you have the amounts. Notice how if you spend more than you receive, of course, it's going to be unbalanced, right? You should always receive more money than you spend, and that goes for everybody. You can't spend more than you have or receive. Okay, so let's begin. We mentioned the first thing we're going to talk about is the structure, right? The structure of the financial area in your company. Now, the tip of this pyramid would be the CFO, Chief Financial Officer, which is the person who is going to make the administrative decisions related to the money management in the company. Okay. Um, this person is a member of the board. Okay, I'm sorry for the typo. The BOARD, the board, and there are normally two senior managers below this person who respond to him. Okay, so remember that just like the CEO or the chief executive officer is a member of the board, and we mentioned also that the board is a group of people assigned by the shareholders or stockholders to control the company and just be aware and take care of their investment. The CFO is the person who is in charge of all the financial activities of the company. He is a member of the board, and there are always two senior managers that respond to him. The next person in this pyramid will be the financial controller. Okay, so he responds directly to the CFO. He is in charge of planning, which means preparing forecasts and budgets. Forecast is what you think or you imagine you're going to spend or use. Next, monitoring, and how does this happen? And he does this by comparing the planned spending with the actual spending, and this has to be with the forecast, right? Okay, so I assume or I presume that we're going to spend a certain amount, and we're going to compare it with what we're actually spending. Okay, so this will be monitoring. Then we have producing. When we talk about producing, it refers to the financial data or data for the senior management team. So he is going to prepare all the information, all the documents, all the charts and all the numbers, and then he's going to give it to the senior management team so they can know what is it's like the diagnostic of the company or how things are going. And finally, he analyzes the in major investment decisions. So he receives all the proposals and everything that the businesses or things or that could happen, and he decides if it's possible or not to invest. Okay, so he has a final call in this. Excuse me. Next, that's the third position is the treasurer. Okay, he is basically the person who manages the cash flow, and in case he needs money, he figures out where to get it. Okay, so he is the person in charge of basically the cash. Okay, he is going to decide where the money goes and know how much money we have or how much money we need. He is the third member of this pyramid. And then we have the chief accounting officer, right? He's going to keep the company's books. Okay, when we refer to books, we refer to the accounting books, right? He's going to prepare the statements. He's going to prepare the tax returns. He's going to develop strategies to minimize taxes, not as a fraud, but as to help the company, because everybody needs to pay taxes, but there are ways, or there are certain activities that can be compensated when we pay taxes. Like education or helping charities. This can help you reduce the amount of tax you have to pay. So this is the responsibility of the chief accounting officer to keep the books, maintain the books, prepare the financial statements, all the documents that need to be prepared. To prepare tax returns is when you need to pay your obligations to the to the nation or to the country, based on the business that you have done. And finally, to um, in accordance to what we mentioned before, develop strategies to minimize taxes. Okay, it's not bad to pay taxes, but like I said, there are certain rules and certain laws that benefit taxpayer if they pay on time, if they do certain investments, and this could help them lower the amount of tax that they're going to pay, or also the amount of tax refund that they're going to receive um, for certain actions that they may have. Okay, so these are the four people that we can mention in the organization of the financial activities in a company. The CFO, okay, that's the first one, that he's the one who's going to make the decisions. Then we have the financial controller, followed by the treasurer, and finally the chief accounting officer. Okay, normally it's like this, it goes up, it's like a pyramid. The bottom level responds to the higher levels, but companies nowadays tend or try to be more horizontal than vertical. To I mean, everybody works and everybody assists everybody else. Okay, so this has to do with the organization, what we mentioned before. Next, let's talk about managing the cash flow. Like I said, cash flow is the making sure that the availability and your cash capacity is sustainable, that you never run out of money. Okay, that you always have money to invest, or to you always have money to take any action that is necessary, and you don't feel that you don't have anything or you don't have any money in the case you need to take any action. Okay, so first let's talk about actions that cause cash flow problems. The first one that we're going to mention are late payments or non-payments. You know, when we pay after the date, whether we make the late payment or we receive late payments, and that can cause us problems. Okay, and also non-payments when sometimes when we make business with somebody and they just decide to not pay, and this is called a non-payment, and this can cause an interruption of the cash flow. Next, unforeseen costs, you know, things that appear that weren't projected, that weren't planned, and maybe because of an accident, or maybe because uh, um, problems in the warehouse or the factory that may occur. You know, these things, accidents may occur, and these could generate unforeseen costs. Next, an unexpected change in demand. That means that, for example, if we have budgeted that we're going to make 100, but then all of a sudden we need 200, and maybe our financial budget was specifically for a certain number, we might have issues. Okay, so this might cause a problem in the cash flow. And finally, overborrowing from the bank to finance expansion plans. And by overborrowing, that means that you ask for more than you could handle. Banks will help companies to be able to accomplish certain projects that they have. Um, but of course, they need to be done in an intelligent and in a thoughtful manner. You can't expect to, like I mentioned before, to spend more money than you will receive or that you will have, because eventually the bank is going to ask for its money back. And if you don't have it, then you're going to have more issues than more problems than solutions. Okay, so these are four things that could cause an interruption or a problem in the cash flow of a company: late payments or non-payments, unforeseen costs, unexpected changes in the demand, and overborrowing from banks to finance expansion plans. Now, some solutions. The first solution that we can mention is credit control. You know, make sure you know who you're going to lend money to, and how you're going to evaluate the people that might need the money. Stock control also. You want to make sure um, that your stocks are in 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 control, that you don't lose control. I mean that they're not overvalued, or that they're not undervalued. The same with expenditure control. That means that you're going to know that you're never spending over of what you have. Like I mentioned before, these are all solutions to some of the problems that I mentioned before. You know, you can only spend what you have, and you cannot spend more than you have. Next, marketing initiatives. This will try to increase sales, to try to increase the cash flow, to try to increase the recycling of money and make it go round and round, and maybe that way we can receive or have more profits. And using an outside company to recover a debt. And this is when mentioned what I mentioned before about non-payments, right? When somebody owes you money, and I mean you've done all you can to recover that cash, and for some reason you cannot. So sometimes it's relevant, imperative, and sometimes it is useful to hire an outside company to recover this debt. You know, to make sure this money is not lost. Okay, so these are some of the problems and some of the solutions about cash flow. You know that there are actions that can interrupt the cash flow when somebody owes you money and doesn't pay it, but there are also ways of finding a solution, like hiring a company to recover that. Okay, one problem could be overborrowing from a bank, and the next one we have the expenditure control. You know, so there's always, every problem has a solution. It's not bad if you have the problems, what is bad if you do not find a solution. Okay, very good. So this is what we want to mention referring to cash flow. Okay, excellent. Let's continue. Now, we mentioned that one of the problems that we may have is new funds. I mean, okay, I am running out of, of money and I need the cash. Um, where do I get it from? Okay, one source, of course, could be banks, but there are others. So we have equity financing and the debt financing. Okay, so these are two ways of finding a source for new funds. Okay, now when we talk about equity financing, we mentioned these three topics. Okay, equity financing could be associated with reinvested earnings. So all the money that I have received, because of my profit, instead of spending it in things that are not related to the business, maybe I can take this money and reinvest it in the company. That way, all the profit that was gained is used in the company. I don't need to take money out of a new place or another place. I'm just using the money that the company generated. Okay. Another one is the sales of assets. For example, okay, I'm going to sell things that I already have and that have certain value, but I need the money. So instead of asking for a loan, instead of asking for a bank to give me money, I generate the money from things that I already possess. Okay. And that way I avoid kind of generating debt. And finally, the issue of new shares. So this is just selling shares in the stock market that will generate an income for the company. In these three manners, we do not generate debt. Okay, because all the new funds are appearing or come from the first are earnings. Okay, so instead of, for example, this company generated a profit of $100,000. So, and then my company needs $80,000 for a certain business. Instead of me going and asking the bank for a loan, I just take this money that I just profited from my company and reinvested it in my own company. This way, I avoid asking for money. The same with the sales of assets. I have something that is of value. Instead of asking for money, I sell it and I use this money that I received for whatever I needed. And the same with the issue of new shares. I just sell new shares to people to stockholders, and instead of generating debt, I my own company is generating the new funds for me. And the next one is with debt financing. Okay, now here is where we generate debt. Here, for example, a short term is a trade credit or a bank loan. Okay, um, that means that I'm going to generate um, money. I'm going to generate a fund, but by asking a bank or a credit entity to give me the money. Okay. Um, Here I am receiving, or I have a new source of funds, but and the cost of what? Of generating debt. Okay. Sometimes it is necessary if none of the other three things are possible. Okay. But it generates debt. Okay. So short term, that's because even if you want to go with bank loans that are maybe for 5 or 6 years, it's still short term because it will eventually finish, right? And but then we also have long term sources. Okay, a long term source is um, the issuing of bonds. Okay, a bond is when it's an instrument of in indebtedness of a bond issuer to the holder. That means that, okay, it's like what we used to it's a document that means that you are practically like an owner of this company of this. Okay, you're going to give me money in exchange for a document that has certain value. Okay, that means that I will owe you this money um, until I cancel that bond. Okay, bonds are basically used sometimes between countries. Countries sell their collocate their values in bonds, and they tend to be long term. I mean, not 5 or 6 years. They tend to be for longer periods. But still, they generate debt because if you don't pay, then the person who holds the bond has certain rights over your company or whatever is stated in the bond. Okay, so this is a way of recurring or accessing new funds. Okay, one is recurring to debt and one is recurring to avoid and one avoids debt. Okay, you will have to decide which one is better for your company. Next, we have issues in the financial management. Okay, now here are some issues. For example, cost centers. These are discrete business units where budgets are spent. Okay, and then we have profit centers. These are units where profits are generated. So one generates profits and one spends. So notice the difference between a cost center and a profit center. Okay, one spends budgets and one generates profits. Next, we have a variance analysis. It's when we compare the planned costs with the actual costs. Okay, so again, we mentioned it before, right? We evaluate we plan a certain budget, and then we compare with what we actually spend to see if we have a negative outcome or a positive outcome. If it's positive, that means that we planned well and that we spent our money well. If it's negative, that means that we spent more than we had planned. Okay. um, then we have costing methods with standard costing versus marginal costing, valuing assets, the value that our assets have. And finally, we have ratio analysis and to analyze performance in more depth to compare companies in the same industry. And the other analysis is with liquidity ratios, profitability ratios, leverage. So basically, in one is we compare our it's a comparison between companies. Okay, I'm going to analyze how this company is working and how this company is working and see how they perform. Where the other one is we analyze, but we don't analyze companies, but we analyze specific situations or details of our company. This is more like an inside work, or more than comparing yourself to another entity. You're comparing specific numbers or specific content. Liquidity, profitability, leverage, etc. Um, when we say leverage is debt, leverage means that um, it's not a positive thing. When you have a debt, you owe money to somebody. Okay, so and that gives that other company leverage, because whenever you sign for a loan, they're always um, just as you have responsibilities, uh, the bank also has rights. So it could be used as a leverage, as a way of control. Okay, a debt can be used as a way of control. So this also has to be analyzed. So all of these are financial issues that appear or can occur in the financial area. Very good. Remember that I can follow your questions in Facebook and also in Zoom. Okay, so if you have any questions, just let me know, so I can answer them as soon as I read them, because sometimes I read them immediately, and sometimes I read them a little bit after they were written. Okay, so just letting you know that I can help you through these two areas. Now, preparation of accounts. The accounting process starts with inputs, and these are things such as sales documents like invoices, etc. Purchasing documents like receipts, payroll records, bank records, travel and entertainment records, and then we need to collocate. We need to input all this information to be processed or to be adjusted or for accounts to be created. So the first thing that we need to prepare is the entries. Okay, everything, all the money that is that enters, right? They are recorded chronologically into journals. A journal is where you record all the money, all anything that enters. Next, the information is posted. Information is transferred into ledgers. A ledger is like a journal, but a bigger one, where it accumulates in categories. Okay, cash account, sales account, etc. Okay, now the first one is when we receive all the information. Okay, all everything is mixed. The next is where we collocate specific information in a specific categories and in ledgers. And then we have the trial balance. The trial balance is prepared at the end of each accounting period. Okay, an accounting period is basically set by the company. This is a summary of the ledger information to check if the figures are accurate. It is used to prepare the main financial statements, income statements, balance sheets, or cash flow statements. So it goes from little to big, right? So first we receive all the information. Next we collocate it according to areas, and finally, now that we have all the information, we use it to evaluate performance, to evaluate debt, to evaluate cost. It depends on what we need it for. Okay, but we use it to make sure that everything concurs, that all the numbers are correct, and that the everything is working fine. If the numbers don't match, then that means there's a problem. Maybe some information was not given, maybe it was misunderstood or misinterpreted, and we need to go back to review where the problem was. Okay, so these are three steps of preparing the accounts of a company. Okay, to see the numbers, to see all the information that is needed, eventually to demonstrate the health of the company, how things are working. So again, we go from everything together to separate it by type, and then finally all the types are compared to see that everything is working out fine. The financial statements of large companies have to be checked by an external firm normally, who sign off on the accounts. Okay, in what is officially declares the accounts are correct. Okay, an external company will review your numbers and say, okay, everything is fine, everything is proper, and then they are publicly available and appear in the company's annual report. Users of financial statements include shareholders, creditors, customers, suppliers, government agency, etc. Okay, so this is how when you want to after you have done the three steps that I mentioned, normally an external company is hired to make sure that the numbers coincide, that they are correct, that they are proper, and then after they have been verified and signed off, then they can be published in journals or to the shareholders or anybody who is interested in this information. Okay, um, so this is how you make your accounting. Okay, this is how normally accounting is prepared. Very good. No questions? Remember that I always check both places to see if there are questions. No? Okay, good. Okay, profits and loss accounts. The profit and loss account, income statement, or the P&L summarizes business activity over a period of time. So this is a summary of all the activity that your company has had over a certain time. You decide a year, 6 months, 3 months. Okay, it begins with the total sales or the revenue generated during a month, a quarter, or a year. And the subsequent lines then deduct or subtract all of the costs related to producing that revenue. Okay, so the revenue is everything that entered, and then you subtract all the losses, all the costs, and at the end you will get your final number. Okay, so you decide if you do this monthly, quarterly or yearly. It depends. Every company is independent on deciding how much time they're going to set between evaluations, the profits and their loss. Okay, so the profit and loss account can also be referred to as the P&L. Balance sheets. Okay, the balance sheet reports the company's financial condition on a specific date. Okay, so this is how much money we have right now. I want the balance sheet. Then, if the CFO asks for the balance sheet, then you give it to him, and it will tell him how you are in that moment, how much money you're making, how much money you're spending. Okay, the basic equation that has to balance is the assets. Okay, the assets is the liabilities plus the shareholders' equity. Okay, um, um, an asset is anything that is value of the business. A liability is the amount owed to a creditor, and the shareholders' equity or owner's equity is what remains from the assets after all creditors have theoretically been paid. Okay, so this is the formula. Okay, the assets equals liabilities plus shareholders' equity. Okay, so again, an asset is anything of value of the business. A liability is anything that is owed. Okay, all the money that you owed, and the shareholders' equity is what remains after all the creditors have been paid. Okay, so these are common. This is common terminology in accounting: assets, liability, and shareholder. Okay, so remember that an asset is something of value, a liability is something that you owe, and the shareholder or stockholder equity is the money that is left after all our debts have been paid. Let's see. Yeah, I mean, remember, an asset is anything that is a value for the business. A person could be an asset. A business, a building could be an asset. Um, Machinery can be assets. Uh, um, an asset is anything that is of value for the business. Of course, when we talk about maybe selling assets, we don't include people, but yes, I mean, an asset is anything that is of value for the business, anything that is valuable for the business. Thank you for your question. Share capital representing the original investment in the business when shares were first issued, plus any retained profit that have accumulated over time. Okay, so share capital is the original investment in the business. Okay, when you first, what was the value of the business when the company was first opened or shares were first issued until now? Okay, how much profit has the company or the shares of the company accumulated over time? Okay, so this is called share capital. Um, I know sometimes it can be confusing because when we mention share, we talk about sharing, like the word actually means, but in this case, it refers to shares or stocks. You know, so the share capital is again the value of a share when the company was first, or a stock when the company first started, to how much it is valued after all the profits that it has accumulated over time. Okay, of course, that's another way of measuring the health of a business. Okay, if the share capital is considerable, then that means that everything has been run and things have been looking fine for our company. Okay, now assets listed according to how easily they can be turned into cash, with current assets being more liquid than fixed assets. Okay, we're going to talk about that, what current assets and fixed assets are in a minute. But like I said, this is a way of an asset is anything that is value to the company, and of course can be sold or used as income. Liabilities, they are listed according to how quickly creditors have to be paid, with current liabilities for banks' debt, with being paid before long-term liabilities. Like I said, liability is everything that you owe. Okay, a liability is you might owe to a bank, to a financing company, etc. Whereas assets, it's value. Okay, anything, it's the opposite. It's not debt, it is value. Figures for current assets and current liabilities are particularly important to a business. The amount by which the former exceeds the latter is called working capital. Okay, so the amount where your current assets surpass your liabilities is your capital. Okay, so for example, let's say your assets are 100 and your liabilities are 80, you have 20. That is your working capital. Okay, again, normally your assets should always be greater than your liabilities, because if not, then you have accounting issues. Okay, this is a measure of whether there is enough cash freely available to keep the business running. Like I said, your assets should always be higher than your liabilities, and the result of the assets minus your liabilities, that amount is your working capital. That is how much money you use to keep your business working and flowing. Okay, so be careful, always be careful. Your liability should never be higher than your assets. This is basic economics. Okay, cash flow statements. This has to do specifically with cash. It's important for companies to record their cash receipts and cash payments. This shows the real cash that is available to keep a business running day to day. A profits are only in paper, okay, until your cash is received. For example, you say, okay, this is my receipt. I just sold, something for $1,000, but that doesn't mean you have the $1,000, because the company still has to send you the check or the money order or make the transfer, and until you have that, then you have no cash. It's only a profit, okay? It's only on paper. There are many ways in which an accounting can manipulate the profits while cash is real money. This is also true. I mean, there are ways to, I mean, the paper can show something, and this happens a lot here in Peru sometimes, whereas the value of something is not what is shown in the paper. Okay, so what is really important is the cash. How much actual money we have to be able to do business, to be able to pay, to be able to buy, to be able to um, uh, pay our employees. Okay, how much money do we really have? Because I cannot pay an employee with, hey, I just made a sale here. This is valued for a certain amount of money. That's not helpful for your employee. Or the same for any creditors that you might have. Okay, hey, I have a big business and I'm going to receive a certain amount as a profit here. You know, cash my debt. No, I mean, you're going to need actual cash to pay debts or to pay bills. Okay, so that's why it's important to have the cash flow statement is relevant and important. Okay, now here are some problems that we mentioned before. Some problems that can happen or that can occur with cash flow. Okay, like I said before, unexpected late payments and not payments, which are bad debts. When people just decide not to pay what they owe. Unforeseen costs, a larger expected tax bill, or a strike. Sorry, it's a type of a strike, etc. Okay, so these are things that you don't prepare, that they just happen because an unexpected thing occurred. Okay, like if it's a strike, where your employees don't want to work anymore until they receive certain compensation for certain claims that they have, then you're going to lose money. Okay, and so you're going to have to take up money out of other places, and this could be a problem in the cash flow. An unexpected drop in demand for some reason. For example, right now with the pandemic, many companies that had prepared their supplies for this year, many of them lost money because there was a drop in the demand, for certain items. For example, gyms, and for example, some restaurants, although they're catching up, but still, um, there was an unexpected drop in the demand of their business. Okay, so they must have lost money. And finally, investing too much money in fixed assets. Okay, you spend more money than you should in a fixed asset. um, and like I said, an asset is anything that has value for the company, whereas a fixed asset are assets that are purchased for long-term use and are not likely to be converted quickly into cash, such as land, buildings, and equipment. Okay, that is a fixed asset. Okay, They cannot be converted quickly. They cannot be sold as easily as other things. Okay. Um, um, if you invest too much here, then you will have problems with your cash flow. Solutions: credit control, chasing overdue accounts. Okay, so you are controlling this. I remember here in Peru in the past, um, many years ago, when I was around 18 or 19, and say I'm talking about late 90s. Um, Anybody who applied for a credit card would get credit. I mean, you just went. They would ask for some financial statements, but back in those days, the financial statements were made by hand, and many things could be altered, and many people got credit cards, and eventually they weren't able to pay their debt, and they became overdue. What's the question here? Yes, and they became overdue, and now the company had to chase them, had to try to recollect this money that was given to them. So defaulting, yeah, well, yeah, like, I mean, it's bad creditors, it's just bad debts. Um, when Like I was saying, now companies control. Let me a second to answer your question. um, um, an overdue account is now occur less and less, because before you apply for credit, you are evaluated in many ways, um, and you're checked in Infocorp, um, and the companies don't give out money as easily as before. They evaluate you in so many ways that it should be difficult for overdue accounts or for defaulters, like, well, to answer your question, um, for to have defaulters get credits, because there's a history of your you have a credit history, so it's difficult to there's more control in the credit. Okay. But if you do have this problem, then you have to chase them. You have to not literally chase them, but you have to try to recollect this money that is overdue. Next, stock control: keeping low levels of stock, minimizing work in progress, delivering to customers more quickly. Okay. um, this is another solution. Okay, so for example, like I mentioned, the example of the pandemic, when this happened, people had stocks for, let's say, the first half of the year. They had no idea that this was going to happen, and they might have lost money. So in the second half of the year, and knowing how things are, people have started to control their stocks. Um, okay, I'm going to have just necessary amount of something to avoid losing it. I'm going to deliver my product quickly to avoid keeping it and having it too much time in the warehouse. I have seen images of stores, or warehouse stores, um, that have been opened after the quarantine, and many products were damaged. Clothing was damaged, sneakers, shoes, they were damaged because they were too long, they were stored too long, and all this is lost money. Okay. Next, expenditure control: delaying spending on capital equipment. That means that, okay, if we need something, we only buy what is necessary. Okay, we don't spend like a crazy person and just, okay, we need this, we need to know what do we need, is it really relevant, is it important, okay, let's get it. A sales promotion to generate cash quickly, that's another solution. Okay, we start making, again, let's use the quarantine example again. Store companies, for example, nowadays have big discounts because they want to sell the products that have been accumulating there for a certain time, and they need to sell it, and this will generate them cash. And finally, using an outside company to recover debt. Factoring: this is when, and that's its name. If you have a debt, you need to recover it. Sometimes you can't do it, so you hire or use an outside company to recover these debts. Okay. Um, basically this is how we fix some of the problems with cash flow. Okay, we might have unexpected things that drop in the demand, but then there are ways, or there are things that we can do to adjust to this unexpected drop. Okay, there are unexpected costs that might be generated because of an earthquake or something, or a strike that you didn't plan, but there are ways of recovering, of um, what's the word I'm looking for? There are actions that you can take to minimize the effect of these problems. Okay, so they need to be taking these actions need to be taken into account immediately, and as soon as possible, and depending on the problem, of course. Very good. Now, I'm going to share a document here, and I'm going to share some vocabulary. Okay, so this is a profit and loss account. Okay, and this is what it's called an income statement. Here we have some expressions, revenue, things that I mean, that you gain, gross sales, net sales. Okay, so this is basically basic accounting. This is everything you sold. Okay, minus discounts and stuff. Okay, it says less sales return, sales discounts. So this was, you sold 640. You're going to discount from it all the sales returns and discounts, and your net sales would be 630. Okay, so your gross from your net. Okay, this is what you got before the discount, and this is what you got after all the discounts. And the same here, right? Everything that is in parentheses are things that are going to be deducted or subtracted. Okay, for example, cost of goods, purchases, salaries of manual workers, transport costs, cost of goods sold. Okay, and this is your gross profit. Okay, so this is what you got after if you add this up, it will be 350. So this is what your net sales, and after your sales is all you invested, 350. And if you subtract 630 minus 350, after doing all the operations needed, your gross profit will be 280. Okay, so your revenues is what you received in cash, your cost is what you spend, and then when you subtract your cost minus your revenues, you get your gross profit. Okay, and it's still gross, so there are still some things that need to be discounted from it, but we'll see that in a bit. Some terminology here: revenue, okay, income, turnover, sales, top line. Okay, so revenue is like, these are synonyms of revenue: income, turnover, sales. The cost of goods sold, this is direct costs. Okay, includes manufacturing costs, salaries of manual, blue collar workers, white collar workers, we mentioned that before, etc. Okay, we're going to see in a bit operating expenses, which are indirect costs. Okay, or also sometimes called overhead. They include the salaries of sales, the office staff, marketing costs, utilities, etc. So notice how we have the cost of the goods, which is what they actually cost to make them, and then we have the operating expenses, which are called the indirect costs, which go to the salesmen, the salaries, etc. Then we have what is called as a non-operating income. These are they include profits from investments in other companies. So you invest in another company as a shareholder, as a stockholder, and you receive, without doing anything, you receive income. So this is called a non-operating income. Then we have the EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. This is like everything you earned before subtracting or calculating the interest, tax, depreciation, and amortization. And I mean, this is like the your profits before subtracting all of these items. Okay, so again, we have revenue, which is income, turnover, sales, cost of goods, which this is called, they're also direct costs, which include everything that you spend into producing an object. We have the operating expenses, which are called indirect costs or overhead, and this is everything, all the expenses related to this product, but not related to the manufacturing of the product, but basically to the sales. Okay, it's like the salaries, etc. Non-operating income is all the money that your company receives from investments more than actual selling. or business. And then we have the EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. Okay, so again, these are some common expressions used when we make a financial statement. Okay, now I'm going to show the other half of this income statement, and here it is. Okay, so this is the other half of the document that I just showed before. Okay, now we have, like I mentioned, the operating expenses. Again, we have the selling expenses and everything that okay, so the total selling expenses will be 100 here because after you added your salaries for sales staff and for advertising, then your general expenses, and you have salaries for administrative staff, insurance, rent, light, etc. Total general expenses 90. And so our total operating expenses will be 190. Okay, the selling expenses and the general expenses. And then we have an operating profit, an operating income. Okay, and so these are all the numbers that we have here. So notice how your EBITDA is 95. Um, you have we have to depreciation is 10 minus 10, so that goes 9 turns 85. Okay, so at the end we have a retained profit. Okay, after all the operations, we have a total of 47. Okay, so again, this is all these topics put into practice. Okay, again, this is basic accounting. Everything that is in parentheses is what you subtract. Everything that is underlined is the adding. Okay, the for example here 80 to 18, so that means that you're going to add and you're going to get 100. Okay, the same here, you add, you're going to get a certain number. You're going to get 90, and then you're going to add 190, you're going to get 190. If it's in parentheses, that means that you're going to subtract it. Okay, so this is basic accounting. Earnings. Earnings, a profit or the bottom line. Notice that we went from there's another there here in the prior slide. We have revenue or the top line, and now we have here earnings or the bottom line. Okay, depreciation and amortization are very similar and are often used the same way. However, depreciation can refer to the loss in value of a tangible asset, okay, for example, a vehicle, and amortization to the loss in value of an intangible asset, for example, the purchase of a license or a trademark. Okay, so notice how depreciation and amortization are similar. They mean there is a loss, but depreciation has to do with tangible assets, things that you can, I mean, like for example, a property or vehicle, whereas amortization is a loss for intangible assets, for example, a license or a trademark. Okay, this loss over time is treated as a cost and written off, subtracted from the profit over several years. Okay, so this needs to be taken away from the profit. Okay, so it is a loss. Next, we have interest. Refers to the money paid to the bank for loans. Okay, this is common knowledge. The bank gives you money with a certain interest yearly or monthly, and in exchange for giving you the money. Dividends is the money paid to the shareholders. So dividend is everything that you need to pay to the shareholders. And finally, retained profit is transferred to the balance sheet where it joins the amounts from previous years. Okay, so this is at the end what we earned, 47 euros. Okay, and after all this activity or operations occur. Okay, and the last document that I'm going to show you is a balance sheet. Okay, again, we have assets, we have fixed assets, current assets, intangible assets. Okay, um, let's explain here. Accounts receivable is the amount owed to the business by customers. Okay, this is that we need all the money that is owed to the business by the creditors. Okay, inventory is the value of the raw material in stock. Current assets may include marketable securities, for example, shares intended for disposal within a year. We already explained what tangible and fixed assets and intangible assets are. But let's do it again. Fixtures are part of the building that cannot be moved, such as lights. For example, here we say where it says furniture and fixtures. Fixtures, anything that from a business or a location that cannot be moved. Fixed assets may include long-term financial investments, like I mentioned, like a loan. Intangible assets include patents, trademarks, and goodwill, like we mentioned before, things um, um, that I mean um, that have your reputation, things that you cannot literally see. I mean, things that are more subjective than objective. Okay, and these are called intangible assets. Okay, and again, this is just a very common and easy mathematical equation. Okay, um, everything that is in parentheses is going to be subtracted, and everything that is underlined is going to be added. Okay, and finally, to finish, is this terminology: bank debts or loan capital includes any overdraft. An overdraft is, for example, if the bank gives you, I'm going to give you a credit line of 1,000, but then you spend 1,200. Those 200, that 200 amount is overdraft. You went over what was given to you. Accounts payable is the money owed to suppliers. Okay, you need to pay all the people that helped you with your business. Accrued items are those where an expense has been incurred, but the money is not yet paid. Okay, accrued salaries typically includes future bonuses. Okay, so um, I owe this, but I still haven't paid it. Okay, another item, provisions, can appear under current liabilities. Remember, the liability is the money that you owe. These are amounts set aside for anticipated one-time payments that are not part of the regular operations. Perhaps a lawsuit, a compensation package. Okay, so these are you prepare. It's like you imagine what could happen, so you have it there just in case. A mortgage is a long-term bank loan to buy a property. Okay, pronunciation is mortgage. Okay, with bonds, the principal or the amount raised by issuing the bonds is repayable to the bondholder as maturity. Okay, so that's what the principal means. Share capital, like I mentioned before, is all in English is also American English is called common stock. Is the amount raised at initial flotation of the stock market. Okay, how much money your stock is valued with since when you started until now. And finally, the retained profits or returned earnings. The figure showing here is more than 47,000 euros transferred from the income statement because it's the amount accumulated over several years. Okay, so that is the retained profit. Um, and basically, this is a statement is. Okay, what a balance sheet looks like. Okay, and here are some of the terminology used to make when we refer to these as to these statements. Okay. Um, Thank you. I mean, I think we've run out of time. Yes. Um, Remember, the next topic that we're going to talk about on Saturday is going to be the financial market. And I hope the topics were clear. And I hope, again, this is business for specific purposes. So we're only going to mention topics and we're going to mention terminology used in business. Pretty soon we're going to have some general English classes where we talk about more about the language rather than the use of the language in specific activities, in this case, accounting. Okay. Thank you very much for your attention. Um, there will be a small evaluation that can be found in the Cámara Peruana de Comercio Exterior, so you can ask for them. You can ask them for it. And thank you very much. Here's my personal information. If you have any questions, any doubts, anything that I can help you with, please don't hesitate in asking. I will gladly try to solve your answers and clear out any doubts. Thank you for your time, and I will see you on Saturday. Thank you very much.